NGMI and HFSP. Do you ever feel like the lexicon is leaving you behind? Welcome to the ultimate crowdsourced personal finance show. This is Choose FI.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, guys, excited to dive into this week's episode. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, what's going on by you?
Well, I was actually in our Facebook group and I saw at the end of a comment someone leave an acronym. And the particular acronym was NGMI. And it sounded like a negative thing.
Okay.
And so I had to go look it up. And I realized that the lexicon has indeed completely left me in the dust. Now I'm caught up now and I'm super excited to share it with everybody listening to this that's not caught up. And some people are groaning because this was so known. But I think that's my larger question. Like when the general populace accepts an acronym and just rolls with it, like LOL, right? All of us got LOL. But the speed at which the acronyms are landing are so fast. And because you're on social media less and less, you're just not caught up because these are acronyms that live entirely in the world of chats and forum channels and social, et cetera. They just don't exist in real life. You start to feel like, maybe I'm aging out. Maybe I am, in fact, aging out.
Yeah, I hear you. I've always been very leery of even just like the common ones. Like I just thought they were kind of ridiculous. And I don't know, maybe that's some like weird, like, grammatically correct or elitist type thing. But like, I never understood why people did it until I actually started with Twitter in the last couple of months, right? So, I mean, you have a significant constraint when it comes to literally the number of characters. So every single one matters. Like I'm used to doing my like 2 spaces. I know there's arguments with this, but 2 spaces after a period.
What?
That's down to 1. That's like old school. Like instead of saying the word and, I put the ampersand, so it's like, I mean, every single thing matters. But yeah, you see all these wacky acronyms and yeah, NGMI is not going to make it, right? Is that what it counts for?
Yeah, not going to make it. The other one that I saw on a similar chat forum was HFSP. I had to look both of these up. Now I'm sitting on the knowledge for the last week or so. But, prior to that, I was in the dark and I would have glossed over it. Have fun staying poor.
Oh, goodness. Oh, that's funny. What's the, like, I wonder what the instance is where people use that. Is it like,
I think, and this is the reason it's relevant, these appear to be mostly tied to investment strategies, right?
Okay.
Like the 2 times I've seen this popped up, it's actually explicitly tied to crypto investing or lack thereof, or maybe a particular one that you're in as another one. I'm not 100% sure, but it's very interesting as, the week that we're talking right now. And as we're recording this, SHIB, which is even more of a meme coin than Doge, which was also known as a meme coin, has gone to the degrees in such a short period of time that if you were to have invested $8,000 of it just a mere 12 months ago today, and someone actually apparently did this today, you would have $5.6 billion right now today.
Wow. That's very, very interesting. That sounds eminently replicable for all of us, right?
So that person that did that could absolutely drop in their signature line to everyone else that did not do exactly what they did. Have fun staying poor. And they don't even need to use that many characters there on Twitter. They could just do HFSP, preserving, each individual letter for maximum impact.
Wow.
So, we try to think of ourselves as educational. Sometimes we try to provide information around general investments, but sometimes it's just giving you basic acronyms. The way I thought we could take that, kind of springboard, Brad, is actually spend just a minute talking about, SHIB in this particular case, because I know I heard that, that kind of return, I don't even know that quadrillion percent return, whatever that was, that takes $8,000 and turns it into $5.6 billion. And I think I've I'm doing something wrong with my life. What?
Yeah.
But I think we need to unwind that a little bit and, figure out what is actually, maybe not exactly what's happening, because it's hard to know exactly why that shot up so high. But I think one thing to point out is, Brad, do you believe that if that person had turned $8,000 into $5.6 billion, do you think they could cash out that is that $5.6 billion real?
Yeah. Oh, that is super interesting. I mean, I guess that speaks to liquidity in the market, right? So like, could they basically get, and I'm going to put my own spin on this, could they find 5.6 or $7 billion worth of suckers money, right? Because that's in essence what they're doing. Could they find that? I find that hard to imagine. Like if they just all of a sudden went to a crypto exchange and listed how many ever SHIB or whatever other nonsense this is, they listed that on the exchange, the price presumably would plummet, I would have to imagine. I cannot fathom a scenario where they could cash that amount out. I mean, is that roughly what you're thinking?
I think so. Yeah. I wanted to go back to the core concepts because I've purchased cryptos on various platforms, and I've seen just even how when you try to put an order in for, a certain number of units, doesn't matter what it is, but in a low liquidity market where there's not a lot of people buying and selling, someone has here's the most I'm willing to pay for something, and someone has, here's the least I'm willing to sell it for. And so, in something like Coinbase, which is a super high liquidity platform, lots of people posting their offers on both sides, those get matched up so seamlessly you don't even see it, right? And so for big coins that have lots of liquidity, your market price is going to be within probably a few cents of what you actually wanted. But with low liquidity, where yes, like the thing with SHIB is, I remember I had a little SHIB a while back. I don't have billions of it, but I was dabbling with this. No, it's funny. It's funny because I think it adds some context. $150 bought you, I think I had like $150. $150 bought you 5 million SHIB tokens. So was I a 5 millionaire? No, I just had 5 million of these very low value, like so many zeros behind the decimal that nobody could really even calculate the value of one. And so you're not purchasing one or selling one at a time. You're buying almost in units of a million because they are so worth less. Now they're worth a little bit more. Now, here's the thing.
Worth being an interesting word in there, right?
Worth. Yeah. You're right. So let's say someone goes in and tries to sell $1 million worth, $5.6 billion worth, whatever that number is. Are they going to find that many people at that amount of money that are willing to pay that? If not, then the price goes down until someone is willing to pay that. And then the price goes down and you keep going on down. So if you're just doing market orders, you scoop up, 1 million SHIB tokens at the asking price, then you keep working your way down. But there's not that many people, trying to buy it relative to how many you're trying to sell. And so if you're doing it on a market order basis, what you end up getting keeps dropping.
Yeah, that is really interesting. So obviously, hopefully, not too many of our listeners are looking to go out and buy SHIB, but I think this is more, I guess, a conceptual framework of supply and demand, first off, which is a broad market mechanism. That's just a fundamental of economics, right? Supply and demand. But also, this reminds me of the regular stock market, right? So the stock that I follow kind of jokingly, aspirationally, is Berkshire Hathaway's Class A stock. Jonathan, this is like a dream of
mine.
What
are they, like $200,000 for one share on that one?
Yeah, I think it's probably 400,000+. I haven't checked in a while, but yeah. So, I mean, it's utterly ridiculous because you can buy the Class B share of Berkshire, and that's like 1/1500th of the A share. So, I mean, aside from some voting rights and basically just like this bizarre prestige in your own head of like having the A share, there's no reason whatsoever to do that. So this is stupid, I know, but what you're saying is, when people look at the difference between that bidding price and the asking price, right? The sell and the buy on a stock like Apple, where there is a massive amount of liquidity. There are, I mean, I don't have the exact number, but let's say 1 billion shares outstanding and issued. The bid-ask spread is tiny. It's minuscule. Whereas on a lower liquidity stock like Berkshire Class A, of which, those are $400,000 a pop, plus or minus. And I mean, there just isn't that much that's being bought and sold every single day. So you'll see that spread be significantly larger than on a stock that's an Amazon or an Apple or any of the FANG stocks, whatever. That's just, again, it's market dynamics. So it's interesting to see something like that, even in this wacky world of crypto, where, it's the same fundamental concept. And that's what's cool, I think, about just investing generally, is like when you have the knowledge, when you have the skills of this, then it translates, right? So, Jonathan, I know nothing about SHIB. I know nothing about, some of the exchanges where you could probably buy this wacky thing, but it's the same mechanism that I'm used to with regular stock market, right?
The point that you're making is super critical for people to understand. Using this example of this person that's trying to unload $5.6 billion now of SHIB, which probably would translate to a quadrillion SHIB tokens, right? Because these are very, very low price per token units that we're talking about here. What's happening here is, as the market is rising, there's FOMO that happens, like, oh, the token's going up, I want to get in on the ride. And so they're increasingly buying at higher levels. But then if someone tries to unload that much, because of the relatively low liquidity, the relatively low number of people that are coming in to buy at that price, it starts to go down, which then shakes the overall euphoria that the market is feeling. And so other people are like, oh no, I need to sell at the top. So they then also pile in, because there's no real confidence in this token. This is a token literally with zero utility. No one is making the case. There's a few people, at least with some of the others like Doge, that are making a case. No, it could actually be something. It could be used X, Y. I don't think anybody's even pretending that in this case with SHIB. And it doesn't even matter. Forget that. That's just to kind of add. Nobody has that much confidence in their coin. They just think that, well, if it went up 1,000%, these coins are only 0.0000007 cents a coin right now. What if it went to just 1 cent? I could make a 10 bagger, a 20 bagger. So FOMO is bringing them in based on the low value of the coin. But as soon as they see it dip, because again, someone's selling 5.6 billion, there may be a few people that say, oh, well, buy the dip. But then if it continues to go down past that first dip, which it will, then they're like, oh no, this thing's collapsing. And everybody just tries to dump their coins, and you can't get to the bottom fast enough. There's 10,000 cryptos that are out there right now. 1,000 of them have completely disappeared. Some of them have gone to staggering heights and completely disappeared. So, really, you're talking about, paper gains not being real gains, because there's no underlying utility or function or thing that they do in the universe.
Yeah. Jonathan, I think that seems pretty clear that SHIB has no utility. I agree wholeheartedly. And again, what you were just saying there actually made me think of another kind of market understanding, or just understanding of how companies are valued, right? You're saying, in essence, so again, we're going to use this kind of silly SHIB thing, but it's a perfectly applicable thing for stock market, right? Which is, the sales happen, the buy and sell happens at the margin, right? So it's that next person, what they're willing to pay for that stock, or in this case, this ridiculous meme coin. And that dictates the price, the current price of what you think of as, this is worth X, because that next person is willing to pay either that amount that you see, a little bit more, a little bit less, right? And it is always getting matched up with the seller. But where this becomes real is the market capitalization. And that's the intersection of this liquidity. Because what you do, and we're going to talk about the coins here, but I'm going to quickly get back to stocks, is you basically take all of the outstanding of these coins and you multiply it by the last sales price, and that gets you the total market capitalization of that coin. Okay, so let's say there's 1 billion coins and each one's worth $2, then the market cap is $2 billion. Okay, so if you had every single one of those billion coins, you'd be worth $2 billion. But Jonathan, to your point about liquidity, if you try to sell all billion of those coins, you're going to find most likely really quickly that they're not worth $2 each. So that's very similar in the sense of this market cap for the people listening here of, hey, what happens with the stock market? So let's just say now a stock, right? Now, this is how you look at what's the value of that company, but you're really valuing it based on what was the last sale of a share of that stock, right? So if there's 1 million shares and the last sale was $100, you would just take 1 million times 100 and say, oh, that company's worth 100 million. But again, it's liquidity, right? Like, is someone coming in and looking to buy that whole company? That to me is like proof is in the pudding type thing of, hey, is this company actually worth this? Like, an interesting kind of thought exercise, Jonathan, would be Amazon. Let's say Jeff Bezos owns X percent. I don't know off the top of my head what he owns, but let's say he owns 30% of the company. If he unloaded 30%, if he unloaded all of his shares tomorrow and all of a sudden the market was flooded with 30% of Amazon stock, do you think the price would go up or down? I think to me, market mechanics would say the price most likely is going to go down. Now, you would see really quickly what are the fundamentals of Amazon, right? Is the price going to drop from, I think right now at the time of recording, it's like $34.70 for a price, a share of Amazon. Would it go down to 2,000? Probably not. Would it go down to 3,300? Maybe. I'm just guessing off the top of my head, but it would be really interesting to see something like that happen in practice.
Well, I think with a company like Amazon, as you just mentioned, what it would go back to as it's dropping would be fundamentals. That's the bulwark. That's the underlying strength that it would have, is that there are people that are doing calculations using methods like Brian Feraldi talks about, with his checklist, looking at price to earnings ratio, looking at expected growth, looking at all the different, factors that would go into what is this company actually worth. And then they would perceive value, and people would maybe move assets around or add new money in, but they would aggressively, as opposed to what we have in crypto world is just buy the dip. That's all you got, right? That's all you got with like this type of FOMO mentality, is just buy the dip because it can only go up. No, that's not true at all. In fact, using my own lens of forecasting here, which I rarely pull out because this thing's doomed. Like, it's going to cost some people a lot of money. Take some profits, take some profits. If you happen to ride that one, take some profits. But I think that's the larger point, right? That difference between, why are you so excited about it? Are you excited about it because you think there's some sucker tomorrow that's going to pay more for it? Or do you believe in the vision of whether we could talk about the stock market, or we could talk in this case about, various blockchain or crypto technologies, crypto utilities, et cetera. Are you excited about where this thing is actually headed? Because that's the thesis that you're really leaning on. To just say, I think someone will be dumb enough to pay more for it tomorrow than I paid for it today, is not going to keep you strong the first time, it drops by 30, 40, 50%.
Yeah. And it's so easy for all of us, just as humans, to get caught up in that FOMO. You said this maybe 10 minutes ago, and it was, probably mostly joking, but like, you had some FOMO with this SHIB thing, right? Like, even if it was a little bit.
You can't hear 8,000 to 5.6 billion and not like be totally immune to feeling a little bit of FOMO. Like,
I actually jokingly thought it might have been you, because I knew you put in like $100 or something just as on a lark, but I was like, oh man, maybe Jonathan's a billionaire.
I was testing it for everybody else. I was rotating from one crappy coin to another, just understanding the dynamics. And, I've made a little bit of money with meme coins, with these types of meme coins. But I made it because I cashed it out at some point. But did I leave chips on the table in other places? Yeah, probably. But I didn't really believe in the coins.
Right. But it is fascinating to see, like, again, with kind of a financial independence background and going into, again, I've been on Twitter recently, and it's fascinating. It's really interesting to see people who they get caught up in the euphoria of, crypto or NFTs, and there might be, and I think there are some significant fundamentals underpinning like a lot of this technology. But like, again, I don't know that I necessarily can pick winners and losers, but the people, they get caught up, and it's both euphoria on the upside and then just like running for the hills when things start to, there's like a stampede, right? And, again, like looking at history and looking at market returns and just saying like, man, things just cannot, just simply understanding compounding, right? Like, things can't go up at 100% annual growth rate every 3 months. Like that's inconceivable, right? Like, soon you're talking about having all of the money in the known world. It's inconceivable, but people still, they just don't have the fundamental grasp of this. And like, I look at, man, if I could guarantee an 8% return on all of my money, like in anything, literally anything, guarantee, right? I would put every single dollar I owned into that. That to me would be an absolute slam dunk. But people, that have fun staying poor, Jonathan. I've never gotten that thrown at me yet. But I mean, I suspect I would get a lot of people saying something like that, right? Like, oh, you poor dinosaur, you poor boomer, whatever nonsense they call people that are older than 25. And like, oh, you're not getting 300% every month on your crypto or your staking or your whatever. Like, you're a sucker. Have fun staying poor. Like, whereas I'm saying, okay, if I can guarantee an 8-9%, and you can't guarantee obviously any return. I think that's the last time we saw somebody trying to guarantee a return was Bernie Madoff.
He was so good at it for so many years.
Right. And like his was 12%, but just like literally guaranteeing anything. We are smart enough to know like things do not always go up. When we talk about Jonathan, the percent return we use here at Choosify is 8 on the stock market, but that we're not Nostradamus. We're not forecasting that it's going to be a constant 8% return forever. Like that is ridiculous. That is not the way the world works. There are going to be years where the market goes down 30%. There are going to be years where it goes up 50%. It doesn't work that way. Nothing is constant. But also in my experience and any kind of research I've done on history, like I don't know that anything above a 12 to 15% return exists really on anything. So like you have to kind of check yourself and say like, is this sustainable? Like, am I getting caught up in something that is beyond me that I don't really understand? And I think that's where you kind of get into scary territory of like, if it seems too good to be true, it usually is. But I'm also tempering that with the understanding that like there's new technology coming out, right? Like that doesn't mean that things can't go up 20, 30, 50% year over year for a short time period, whatever that short time period you describe. That might be 3 years, 5 years, whatever. Like I'm not arguing things aren't going to go up like that, especially in this crypto world. But if you ask me, like, the Annie Duke, hey, you want to bet, right? Like that's what it always comes down to, putting your money where your mouth is. Like, is it possible that something could go up 100% year over year indefinitely? No, it isn't. It's not conceivable. And anybody who thinks otherwise, I think, is just not understanding how the world works.
Hey, this is Andrew from the Choosify team. I hope you're enjoying the show. We're going to get right back to it after these quick messages.
One of the things that makes this so interesting is that, over the last month, you had the best chance of doubling, tripling, quadrupling your money if you picked the memeiest coins that were out there, as opposed to the coins with the best fundamentals that you could find, the most partnerships, the most utility. They drastically underperformed the ones that had the most hype or the most, memes built around them. Like, think about that, really internalize that. Like, I think all of us would love the concept of like a moonshot. You make this precision bet and it shoots the moon and the returns just blow your mind. And this happens on the other side too. Some people bet early on Apple. Some people bet early on Amazon, bet early on Netflix, bet early on, the FANG stocks. And they have become wildly wealthy through that. But those companies had really good fundamentals. You probably bought them early before everybody truly appreciated what it was going to be and what it was going to do. But there was something behind that. So taking that same logic and coming over here to crypto world and looking for the underappreciated assets that are out there that are changing the landscape, for many people has been a losing proposition or a good proposition, but not a great proposition. And in fact, in a situation like this, where, maybe you got in on something because it did really well and you thought it had a lot of partnerships. So you bought some. I'm just saying this is the real story for a lot of people in the crypto space. They tried to use certain levels of research to invest in a very specific coin, and they bought it after it had already had some movement, and then it went down. And then the coins that did the 1,000 bagger were the ones that had really cool memes about it, or that Elon Musk might own until he tells you that he doesn't own it.
There was a new breed of dog in it, right?
Right. This is the insanity. The best performing coin today or yesterday, meme coin, was one called Squid Game. Like that was the best performing one. This is the insanity of what's going on in crypto space at the moment. And Brad, you have a comment on that?
Yeah. I mean, I think to me, this is where like people like us have to be okay with that, right? Like it reminds me of like, there are speculative bubbles and euphoria all over the place. And, this reminds me of Christie and Bryce from Millennial Revolution. They talked about housing prices, I think in Toronto, if unless I'm mistaken, but the fundamentals didn't make sense to them. And housing prices in Toronto is notorious for their insane housing prices. But like at the time when we spoke to them, probably 4 years ago at this point, Jonathan, like the prices today, it would have looked quaint back then. The prices were reasonable, but in Christy and Bryce's standpoint, like it was absurd. There were no fundamentals based on what they could rent it for. And housing prices have continued to go up in that specific location. You see this in, San Francisco, the Bay Area. Like you can make, in my estimation, what is the best decision for you, the right decision, quote unquote. And obviously I know that's a loaded term, and still get an outcome that is not favorable. But that doesn't mean the decision was poor. So in this case, if I lived in Toronto or San Francisco, I can't fathom a scenario where I would have gotten caught up in the euphoria of I need to buy a 800 square foot 2-bedroom house for $1.4 million because it's going to go up to $1.8 million next year. Like that is just speculation. And I think sometimes we just have to be okay with, and I'm using the broad we here, Jonathan, obviously, because this is very personal, right? And everyone's situation is different. And if you're going to live in Toronto for the next 100 years, you're guaranteed, then okay, there might be a case to buy. But so I'm not arguing like the specific anecdotes, but I'm saying sometimes you have to be okay with, I'm going to make the best decision for me. I'm going to look at the fundamentals. And if I'm quote unquote wrong on where the speculation comes out, then I have to live with that, right? Which is like this nonsense with SHIB. Like there are, again, in my estimation, there are very legitimate things coming out of the blockchain world. But I don't know where that's going to take us. And I'm pretty darn sure, approaching 100% sure that it's not SHIB, right? Like I am damn close to sure about that. So I have to be okay that some lucky moron basically made $5 billion or on paper. And that it just is what it is.
You're making the exact point that I think I was coming to as well. And, I think part of it is venting some frustration at seeing this craziness happen, but also like trusting your own plan, whatever that may be. I mean, I think it's increasingly clear. I'm not anti-crypto or anti-blockchain, or I think there's something pretty cool going on over there. And I certainly have, coins that I've mentioned in the past and ones that I'm, looking into. And in particular, I know I've talked about coins like XRP and XLM and XDC, things like this. And Brad, I know you've mentioned Ethereum and some NFT technology that you've looked at. So certainly there's, a lot of cool stuff that's out there. But when you do a bunch of research and you make a bet on one of these, and you have reasons that you've invested in such a thing, and a meme coin goes flying by you at 1,000% a day. And this is an overarching principle. You cannot afford to FOMO in out of your original thesis into the one that's the hottest performing one of the day. You don't know what market factors are actually driving that. And pump and dumps and Ponzi schemes and all sorts of other crazy stuff abound in a relatively unregulated place. And let me just tell you, regulations are coming for crypto. They are absolutely coming for crypto, and it's going to be a heavy hand, I bet, relative to what you're seeing right now. Trust the plan. Whatever
Right.
Doesn't mean you never change the plan. You don't modify the plan. You don't make any changes, but don't let an insane return that doesn't make sense at any level be the factor that gets you to change your investing decisions. You will always be chasing returns. You'll always be buying high and selling low.
Yeah. And Jonathan, I think, I keep trying to bring this back to like the real world as we know it, or what we've spoken about over 500 plus episodes. And what this reminds me of is the investor's policy statement. And I know you speak very eloquently on the value of that. I'd love to hear you talk about that and the interplay here. Like what you just said is, I don't suspect there are many people investing in crypto that have investor policy statements. But I know if you've listened to the White Coat Investor on our podcast on his, this is a very, very important thing that you can implement in your life to basically set up a plan beforehand so you don't get caught up in emotion, both positive and negative. And Jonathan, you've used this personally, right?
I have. And you know what? I did not include any crypto in that investor policy statement, though. As you're saying it, I could add some to it. And that's because crypto is not like a major part of my general investing strategy. It's something that, I've done on the side, basically with money that I can afford to lose. It does not, go to your point. If you can make an 8% return over your investing lifetime, you're going to be fantastic. You're going to be absolutely fantastic. But, in terms of an investor policy statement, just generally, an investor policy statement gives you some rules around how much risk you can afford and what you're going to do if the market does certain things. So, if the market goes up here, so here's how I'm allocated. Here's what I would do if the market were to drop 20 to 30%. You just think through some of what's my asset allocation? What is my comfort level? How will I react in certain scenarios? And then when the market does X, Y, Z, you can just refer back to that decision tree. And we wrote about it. We did an episode about it. White Coat Investor did an episode about it. I think the largest thing when you're talking about betting in, something that might be more speculative, whether that be your collectibles or crypto or something else, is that you're not using money that you can't afford to lose. And if it is more of a percentage of your portfolio outside of what you would consider, betting money, et cetera, then you might actually need to consider including that in your investor policy statement, especially for some of you that are more susceptible to FOMO or for making these rash decisions. It could be a good tool that you sit down and you figure out, how am I going to react to XYZ scenario? Like, are you a long-term investor? This is something we haven't mentioned. And this is something, Brad, I know that as you've started going to Twitter, I know that you had a crypto podcast invite you on relatively recently to talk about specifically about, tax implications, making decisions around leaving a position, one way or the other can be pretty expensive on a tax basis if there's a lot of gains actually involved. And so some people, especially in the crypto space, they change positions, about 5 times a minute, or, 5 times a day, large positions, maybe in some case. What are the tax implications of that? And so, are you a day trader or are you a long-term investor? And I think regardless of, like, if you have the day trader mentality, you're going to be super susceptible to this type of FOMO because you're just looking for the day-to-day returns, right? If you're a long-term investor, that's really where an investor policy statement is going to be much more handy. It's not going to be as handy for, day trading scenario where you're just trying to unload your position to someone to pay more so you can go back in and buy it low on the drop the next day or move it into a different asset class. And I think that's the way that you would be wise to think about investing in these types of assets anyways, is over the long term, holding positions for more than a year and adding to that as you feel more comfortable about the thesis. It dramatically changes both the tax implications of that decision, but also how susceptible you're going to be to these types of FOMO swings.
Yeah, and that's an interesting point, that point of differentiation between short and long term. A lot of people don't necessarily realize that when it comes to like any capital asset. So for most of us, that means stocks and mutual funds. It's longer than 1 year, right? And then you get the preferential long-term capital gains tax treatment, which for most of us is 15%. But I guess if you have a really low income or a really high income, it can be either 0 or more than 15%. But that's just something important for a lot of us to think about. And because it's not common knowledge, we need to mention this, right? And we need to mention it a bunch of times. I know we talked about it recently on episode 346, right? Which is all about taxation. But just having that in mind of, oh, wow, like I've owned this stock for 11 months. And I don't suspect many of our listeners are looking to day trade or do any of this stuff. But if I've owned the stock for 11 months and 15 days, well, holding on to it for another 16 or 17 days qualifies you for long-term capital gains treatment when you realize that gain, when you sell it, right? And that's another important thing. So it's just layering on all this information that, like, it needs to become common knowledge for us. Like, you just need to have that language of how does the system work, right? And Jonathan, you actually mentioned, it's funny, lest anyone think that I'm getting away from financial independence and into like NFTs and crypto. It's kind of funny. Like, I actually had like my very first viral kind of tweet storm, and it was actually on NFT taxation, but I had no anticipation this thing was going to go viral. And it was kind of cool in a sense that it was really just the same. It's the same understanding of buying and selling stocks and mutual funds. But I was just trying to educate people in this new space that they don't really understand any of this. They don't understand, how does the system work? What do I owe? Like, what does basis mean? What do I need to keep track of? All of these little things, long and short term. What are unrealized and realized gains? Like all of these things, even making estimated payments, Jonathan, for a lot of us, for small business owners, right? Like, this isn't just for people with stocks and mutual funds or crypto or NFTs or whatever. This is for entrepreneurs as well. People who are contractors, consultants who don't have a W-2 job. Like, you need to make estimated payments, right? So like understanding that that's something that I need to do. then you start layering this information on, and like it just becomes obvious that, okay, every quarter, nobody's withholding federal tax liability for me, right? I don't have a W-2. I've got to send in estimated payments every quarter to the federal government, right? Or I'm going to get hit with underpayment, penalty, and interest. So I actually went on this podcast called NFTs for Newbies. And it was really cool. It was just like talking to the two hosts and like them just kind of peppering me with questions. But it's not like I'm some expert on NFT taxation. It's just I have a background, obviously as a CPA, but just as somebody in the financial independence community on, hey, what does it mean to understand this stuff? And yeah, I mean, it's pretty cool. Jonathan, it was the first time, it was actually kind of cute because of this tweet storm. I was mentioned in a big crypto newsletter called Bankless, and it was Brad Barrett, accountant. It was the first time in like 5 years it's not Brad from Choose FI, which is actually kind of cool. It was just like, hey, this random accountant decided to put out this tweet storm. So, I'm branching out here.
I like it, man. I like it. All right, Brad. Well, I guess my final thoughts on this, for those of you that are looking at SHIB at current prices of 0.00007 cents a coin and thinking, maybe it could make it to a penny. It could be worth at least a penny, right? If that's your thesis, I think there's a better chance that your NGMI HFSP. See how we used all those together?
Impressive.
See how us millennials trending to boomers can actually catch up just real quickly here. And for the rest of us, though, I think there's a really good framework here around thinking about how paper returns translate into real returns. They're not the same things. To realize those returns, you need to be able to sell that and come back into some other asset, right? Some other asset, whether that be another crypto, a stable coin, whether it be US fiat, whether we're talking about the stock market, that's when it's realized. And for those of you that are doing this as part of a long-term drawdown plan, especially in the traditional stock market world, liquidity is not an issue. You are going to be able to draw down at some amount and you're going to be able to have that amount of money to go with. But over here, I mean, these terms are really, really critical. You're talking about market caps, you're looking at liquidity pools. These are just, there's so much more volatility on the day-to-day, on the week-to-week, that really understanding the difference between paper returns and real returns become absolutely critical. Brad, I wanted to switch gears and open up our mailbag. But before I do that, I actually wanted to, because it is tied to investing, wanted to talk about something that I've recently put together. It has to do with Doug and Carol's book, Raising Your Money Savvy Family for Financial Independence. It really talks about, helping your kids reach financial independence on their own, not because you gave them a silver spoon, but because they learn these same principles at a much younger age. And there's a book that they published by the same title, and there's a lot of tools that they mention. One of the ones that they talk about extensively is this idea of helping your kid with a kid 401k and using this as a savings vehicle to encourage them to invest for the medium term, in this case, with the goal of getting a car. And they talk about this extensively, but it's one of Doug's most popular topics anytime he goes to Camp FI. And I'll tell people a little bit more about this. Before I do that, I wanted to actually ask you, has the conversation about which car am I going to get come up with Anna at this point?
Oh, that is interesting. A little bit. She's 13 now, so it's not all that far off, especially in the state of Virginia. You can get your license a little bit younger than I got it in New York. So, we're looking at, plus or minus 3 years here. Yeah, she's asked if she's going to get my car, and I don't think she wants my car. Actually, I don't think she has the same love for Honda Civics that I do. I think it's a little too small for her.
So I think that's kind of the standard, answer in a lot of families is you'll just get the one that's, left over. And that's a perfectly reasonable answer. Another approach is, what if we could use this as a major milestone between the ages of maybe 8 to 16 to encourage them to save for a car, in many ways assisted by us. So what if we could set up some goal of saving, it doesn't matter the number. It could be $2,000, $3,000, $10,000, whatever that number is for a various family. And then we could encourage them to take a combination of their allowance and jobs and save a percentage of that money, which we could then match with some percentage. We could also work in the concepts of the employer match if we wanted to. And then we could work in the concepts of the stock market return. And we could track all of this for them and each year show them their returns to really get them very familiar with these concepts. So at the age of 16 years old, between a combination of what they invested and what the stock market of the parents returned, they would have the amount of money to get the car that you decided at the beginning. So that is the larger concept of the kid 401k.
So that is really cool. For anybody who hasn't read Doug and Carol's book or hasn't listened to the couple episodes we've had with them, just real quick, Jonathan, I guess what you're saying is the parent can ultimately just kind of make these rules up as they go. Like you're kind of like putting air quotes around like investing it in the stock market, because that could mean literally investing it and tracking it, or it might mean whatever kind of framework you set up for this mythical kid 401k, right? This is not like an official government sanctioned thing. This is like you setting something up to not only set for a goal over and think long term, which is not insignificant, right? Imbuing that long term mindset in your kids is hugely significant, but you can set up all the little parameters behind this, right? And set up different mechanisms however you want. So it might mean that if the kid contributes X amount, they get a certain amount of match from you, right? Like if you put in, but you could really do anything you want with this. Like if they put in $500 a year, they get a 1-for-1 match, right? So you put in 500. If they get to another threshold, let's say $1,000 or whatever it is you make up, they could get a different match from you, right? You put in X, Y amount then, or it might mean the return is different, right? And you're tracking all this stuff on spreadsheets and going through it at whatever kind of interval you want, right? This might be a monthly thing, a quarterly thing, and you're teaching them all of these lessons in a very controlled manner. You're not trying to make it unrealistic, because I think it's important. Like if I were doing these lessons, it would be very important to teach my kids that, hey, things don't always go up, right? So like,
do you want to have a bad return month?
Yeah, right. Wouldn't that be interesting? Like, I'm not sure that I necessarily would play that into it, but I wouldn't want them to have these rose-colored glasses that like, oh, you mean if I save, it's always going to go up. Like that's not the way the world works. So it's layering on lesson after lesson in whatever manner and mechanism you choose.
Well, it's funny. I'd be interested to see what your version of the Excel sheet looked like. I was very much happy with the rose-colored glasses. So I worked with MK to put together the rose-colored glasses version of this example.
No, I love that. That would ultimately be how I came down on it. But I would teach them along the way that like, hey, look, this isn't reality, right?
That's great. That's great. Yeah. So you totally took that one away from me there. But
come on.
No, you can. I would be curious to see what your version of this looked like. So I worked with MK to build out an Excel sheet to basically map out over this period of time from 8 to 16. You could go from 9 to 16, whatever. But I built the Excel sheet to basically put the emphasis on the employer match and then a set amount of savings being matched by mom and dad. Then the employer match on top of that, and then also the investor stock market returns over a period of time. And these are all things. And so you're going to be able to introduce these different concepts, and you'll be able to very easily navigate this Excel sheet to figure out what numbers you need to do each year to make sure at the end they're actually going to hit that goal number that you guys decided on. And then it's just a lesson. It's a storyboarding tool for you to encourage them to realize that money saved can actually produce money for you. For those of you interested in the book, definitely check that out. You can find it at choosify.com/books. It's called Raising Your Money Savvy Family. And then very specifically for those of you that were interested in this worksheet, using this worksheet to foster this conversation, we went ahead and created it for you. You can access it as a free download. Just go to choosify.com/kid401k. That's choosify.com/kid401k. And it actually will include the worksheet, but it'll also include a recorded video tutorial to show you just how to use it. And hope you guys get benefit from that. We love your feedback. So if you're on our newsletter, definitely, let us know if you're using it, or share it in the Facebook group if you're getting value from it. And Brad, speaking of the newsletter, I know that you recently had someone share a win with you around optimizing tax brackets.
Yeah, this was a really cool one. So Bryce wrote in and said, after listening to episode 332, my wife and I discovered we had major potential tax savings possible based on our situation. Our combined adjusted gross income is projected to be around $185,000 this year. But I realized if we could reduce our AGI to under $150,000, we would retroactively receive the $1,400 stimulus from earlier in the year, which would be $7,000 total for our family of 5. And we could qualify for the full $3,600 child tax credit times 3, which would be $10,800. As a teacher, I will max out my 403B and 457 accounts for the remainder of the year, which will drop our AGI under that $150,000. This will result in $17,800 in tax credits just for saving more money for retirement. It's basically free money. Living on my wife's part-time paycheck probably isn't possible, but we have a fully funded 6-month emergency fund, so we can dip into that. Living below our means has allowed us to utilize these tax breaks we otherwise would have missed. Thanks for all you do. I mean, Jonathan, how cool is that? So a tax credit is dollar for dollar. So that is not a tax deduction, as we've talked about in the last couple of episodes. This is a tax credit. So that's $17,800 in free money just by understanding the rules, right? And because they've lived a FI lifestyle, they have this 6-month emergency fund. So it's using different money, right? Like in an ideal world, you don't have to dip into that. And you could just use this off of your normal W-2 income or whatever income you have in. But this is the beauty of being flexible and understanding the rules. By just simply using different money to pay for their current expenses, they're able to save a huge amount into the 403B and 457, which, again, as Bryce said, just by saving more money for retirement, we've lowered our tax in the current year, and we qualified for $17,800 in tax credit. So, I mean, Jonathan, this is about as big a win as you can imagine. And I mean, that's just from somebody actively listening to the podcast, but most importantly, taking action, right? It's, okay, now I understand the rules. I heard Sean on episode 332 explain this, and I get it conceptually, but let me go back and look at my situation. What would this mean? And what can I do to make this happen? What can I do to get under that threshold? So yeah, I mean, just huge kudos to Bryce and his family.
You know, it is really good to know, Brad, that the key there is, when do these phase outs actually occur? And I know from tax year to tax year, phase outs can actually change. So knowing whatever you're talking about, there's actually phase outs in a lot of different things. Knowing what those phase outs are, where those lines are, you have control over that with your AGI, especially when you're talking about funding your pre-tax vehicles. And for those of you that have access to multiple pre-tax opportunities like your 401k and your 457 in the scenario that we were just talking about there, you have massive room to adjust your income just by saving more and qualify for more and more benefits as you do. So absolutely a huge win, and take advantage of it if you can. All right, my friends, hope you got value from today's episode. And for those of you, again, that were interested, make sure you check out that free worksheet. You can access it at choosify.com/kid401k. It's a great tool to use to foster these types of conversations with that next generation for financial independence. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.